Financial accounting is a process. It's a process for measuring, for summarizing, and communicating financial information. And we communicate that financial information to external users. Today, in this segment, we're going to learn about the 3 most important formulas that help us understand how to summarize, and we're going to learn about the financial statements that help us communicate the information to the external users. Okay, our first equation. This is the basic financial accounting equation. So basically, this is it. So assets equal liabilities plus equity. So what I want you to do is just think about a house. And imagine that that house cost $200,000. When I got ready to buy that house, I took out a loan and I put down 20%. So I put down $40,000 of my own cash. And then I went ahead and took out a note, a mortgage payable for $160,000. And what this equity is, that's my ownership. So out of this home that I own, I owe $160,000, I have $40,000 of equity. Equity is a dollar amount of value. You can't see, hold, or touch it. But I know when I look at that house, I have something worth $40,000 should I have to liquidate it, sell it, and pay off the debt. From a business point of view, there are a number of assets. There's a house, there's inventory, there's land, there's computers, all kinds of different assets. So think of each of these assets as being listed, and all the liabilities are listed as well. This fundamental financial accounting equation basically says assets, we list them all, liabilities, we list them all, and what's left over is equity. So if you can remember this beginning equation, you're 1/3 there of knowing the very basics of our 3 most important equations. Okay, our second equation. This is what's going to be revenues minus expenses equals net income. So during the course of a period, we have numerous sales, and those dollar amounts are captured in the total called total revenues. Over the course of a period, we incur many expenses. For example, we have to pay our salaries to our workers. We have to pay for the inventory that we purchased. We have to pay for various things just to keep the building running, the lights. So there's various expenses that we keep in mind here. Then after the end of the period, you can actually measure how you did in terms of your operations. Take all of your revenues, subtract out all your expenses. That gives you your net income or your profit for that particular period. I want to tell you a little bit to help you understand the difference between these 2 equations. When we looked at that assets equals liabilities plus equity, think of it like this. This is what the company has. We have so many assets. We do owe money on it, but we have some vested ownership in it. This is what we did with it. So how did we perform as an organization? So think about if you like sports. Given who you have on your roster, think about that as your balance sheet, your assets. This is what I got. What was our record? What was our performance? How did we do for this year? Did we make it all the way to the World Series? Did we win the World Cup? How far did we get given what we had to start with? So this is all about performance, whereas the original equation was more about understanding what we have, what we owe on it, and what's left in terms of capital. Okay, now we're at the third of our 3 very important formulas. This one is called retained earnings. Beginning retained earnings plus our net income, subtract out our dividends, gives us ending retained earnings. Some of this wording might be completely new to you. So let me just explain this a little bit. When you're running a business, you're in the business of trying to make a profit. And so each year that you create net income, think about what we can do as a business. What do we do with that income? We can retain it in the business, and we can use it to buy more assets, or we can give it away to the owners. That's what dividends are. We take part of the earnings and we just mail out checks of cash. That's cash dividends. Okay, so during the course of a business lifetime, they're going to keep track of how they did overall. The first year, they don't have any retained earnings because they haven't started yet. But after, let's assume that they had a good first year, they have a positive amount. Their net income was good. Maybe they paid out just a little bit of dividends. They have ending retained earnings. Then when we get ready to do the next period, we're going to start, this ending is now our beginning for the next period. We'll add in our new net income and we'll subtract out any of the dividends that we give to our owners. So this is the third of three very important accounting equations. This one is a little bit tricky and it might take a little time for this to make sense. Okay, so let's review. The first of our equations was the fundamental accounting equation. And I'm going to use abbreviations this time. Assets equal liabilities plus equity. But I've changed it up a little bit. I put the S in front of it. That's for stockholders' equity, because in this course we're talking a lot about corporations. Corporations have many owners, and that ownership is given in terms of stock. So anybody who owns common stock is going to be an owner. So here's our assets minus our liabilities. What's left over is that part. And we said in the beginning when it was just a house, it was what the owners gave in. So when the owners actually bought the stock, they gave in money in the company, in exchange gave a stock certificate. Well, over the course of time, so the ownership, when they contributed, that's called contributed capital. The second source of stockholders' equity is the amount of profits that are retained into the company. So here's our first one broken down, and now look at that. Guess what? This all is related. So revenues minus expenses gives us net income. Beginning retained earnings plus net income minus our dividends will give us our ending retained earnings. So let's just draw some arrows here. This number is needed to figure out our ending retained earnings. This ends up being related. So here's our first equation, here's our second, and here's our third equation. So if you can just kind of wrap your brain around these three equations, what we're going to do is lay the fundamentals for what we said was summarizing and communicating financial information to those external users. These are the formulas that summarize that financial information. And in our next video, we're going to talk a little bit about the financial statements that help communicate that information.